Thanks for joining me for today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra. Want to increase your financial IQ with today's discussion. So today's discussion is about a discussion I had with some folks at Pacific Life and Aristotle, two companies that I have a good working business relationship with. And this discussion I found to be very beneficial. I learned a lot and really came away with a slight change in thinking about the potential decline in interest rates that is widely expected for 2024 and beyond. My original thesis was that rates would come down largely because inflation has been tamed. This is consistent with conventional wisdom. Additionally, I thought that the Fed would be a little slow in bringing down rates, that they would take their time, they would be in no rush. And this is a little bit different than what a lot of people are thinking. Going into 2024, some people, many people in fact, were expecting the Fed to begin cutting rates as early as March. As of this recording, that seems to be off the table. So that's kind of where I was. But here's what I learned in this meeting. Is that when you look at the federal government budget, they bring in, and before I get through these numbers, please know that these are close numbers. They're not to the penny. If you're double checking my work, I should be very close to accurate, but not completely accurate. But I think conceptually, hopefully I could bring home the points I want to make. So the federal government brings in about $1 trillion in tax revenue. About 22.5 cents of that goes to interest. And that has spiked a lot over the last couple of years because the federal government, as you probably know, has amassed a lot of debt over the last couple of years, especially since COVID. And it was a problem even before COVID. It has only accelerated. I know a lot of Americans are concerned about this, as am I. So about 22.5 cents of every dollar the government brings in goes to servicing the debt. It's basically payments on the debt. And that is much, much higher than it has been in the past. So that's piece of information number one. Secondly, the average treasury debt right now, so the government borrows money. When you look, the average debt on that interest is around 3.13%. So that is about double of what it was when interest rates were near 0%. So when we were in that 0% environment, the interest was below 2%. So it's almost doubled. That's why the 22.5 cents is so much higher than it was before. So again, the average treasury debt is at 3.13%. But, and this is very important, interest rates are currently higher than 3.13%. So the research that I saw was forecasting that the average interest rate that the federal government pays on its debt will go higher. And it will go higher because you can't issue debt today at 3.13%. So when the government needs to borrow today, they are borrowing at higher than what their average interest debt is today at 3.13%. So that's piece number two. Let me add that it's not only when they borrow new money, but the federal government often, I should say, struggled with that, often will have debt that comes due that needs to be re-upped. So they'll have a loan that they made years ago that'll come due. They don't have the cash to pay off the debt, so they'll just refinance it. As an example, today, the 10-year treasury, the yield is around 4.16%. So if they issue new debt on a 10-year loan schedule, a treasury bond, the average rate is 4.1. That is quite a bit higher, I think you would agree, than 3.1. So all this to say is that there's tremendous stress on the budget because more and more interest, more and more, I should say, of what the federal government brings in revenue is going to interest payments. And that will crowd out other priorities that the government wants to spend money on, including entitlements, defense spending, and the like. So the research forecasts that the 22.5 cents is going to likely go over 30 cents, which is unaffordable, simply unaffordable, not sustainable. It would wreck the budget. So the thinking is that this will not happen. It cannot happen. And that interest rates will come down, and that they will come down not only because of what I've been focused on, the taming of inflation, but it will also need to come down, and there'll be a tremendous desire to bring interest rates down to help out the federal debt and for budget considerations. So my updated thesis is not that much different, but it does increase my confidence level in the thesis actually playing out the way that I envision. And that is, interest rates are likely to go down. They've probably peaked. Interest rates probably peaked already or are close to getting to the point where you would look back in time and find out that that was the high point. The Fed will probably go a little slow. They don't have to be in a huge rush, but the impetus is that interest rates will go down because of the dual inflation is being tamed, so they don't need to be as high as they are now. And the Federal Reserve will want to lend a helping hand to the federal budget, not wanting to wreck the finances of the federal government with too much money going towards interest debt. If you are someone that is worried about the federal debt, like a lot of us are, this only enhances your worry because this is a little precarious, isn't it? I don't think the sky is falling. I'm not overly panicked about this, but this certainly is not the federal government operating from a position of strength. All of the excess spending, in my view, poor decision-making, not getting a good return on investment on a lot of the money that is spent, is putting us in a weaker position that if things don't go well, or if there are unforeseen negative events, possibly geopolitically, we could really have a mess on our hands. I wouldn't forecast that. I'm an optimist at heart, but it is something to keep in mind. So that's today's episode. I hope you found the information to be valuable. I was excited actually about going through this because, being the geek that I am as a certified financial planner, I thought this information I got was pretty impactful. So I'll be back with you on the next episode of the Simply Financial podcast very soon. In the meanwhile, check out our website, elliottwealth.com, and please subscribe to the podcast if you haven't done so already. Thanks for listening. Again, I'll be back with you very soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues, or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.